What is going on, guys? Nick here, back with another video. I recently got a really good comment asking me, "Hey Nick, great videos. Can you suggest some of the companies that you've come across other than big tech companies like Google and Amazon that would be a good investment that are underrated but the annual reports seem promising to grow? It will help to understand to see those kinds of companies' financials as well." And I thought that's a really good question. So immediately I went right to my watch list and I looked at all the forward valuations. And honestly, I didn't really see a whole lot that I actively track that were way below their intrinsic value. So I pulled up a stock screener and I started putting in a whole bunch of different criteria like positive income, positive earnings per share growth, low debt to equity. I sorted by largest market cap and I would just work through looking for companies that I thought were really good deals. I found 7 initially, but after looking into 3 of them a little bit harder, I ended up weeding those out, which left me with 4 really good companies if you're new to investing and you're looking for easy companies to understand that I think are trading well below their intrinsic value that nobody's really talking about. Well, okay, one of them is talked about quite a bit, but the other 3, nobody's really talking about them. So the first company is Tyson's, and the first thing that I always take a look at when I'm looking at a new company is how is their income statement over time. So we can see from 2010 to 2019, their revenue grew from $28 billion to $42 billion. This is about a 5% growth year over year for their revenue, and their net income grew from $780 million to $2 billion. Now we can see between 2018 and 2019, their net income actually decreased from $3 billion to $2 billion. The reason for this big dip is because they had a fire at one of their beef processing plants, and it took until about December of 2019 to get that plant back online. Their balance sheet shows that they have about $34 billion in assets. They have $19 billion in liabilities, which gives them $14.5 billion in equity. Their debt is $12 billion, so that puts their debt just below a 1-to-1 ratio with their equity. So the next thing we need to take a look at is what is their long-term prospects. So right now they have a huge percentage of the meat production in the United States. Right now they're producing 20% of all beef, 17% of all pork, and 26% of all chickens processed, at least for 2019. While there are competitors out there with alternative proteins, I'm not really convinced yet that meat production is about to go away in the United States. I know anecdotal evidence isn't always that reliable, but this weekend I was at the grocery store and they were completely out of ground beef and they were completely out of boneless, skinless chicken breasts. Right in the middle of that meat section was the Beyond Meat patties. So I just found it a little interesting that the ground beef was gone and the chicken was gone, but Beyond Meat was still pretty much fully stocked. Tyson's has actually started to work their way into alternative proteins themselves. They actually initially had a 6.5% stake in Beyond Meat, but they ended up selling it right before Beyond Meat's IPO. A month later, they launched their own plant-based meat, but reading their annual report, it doesn't really seem like this has contributed a lot to their earnings yet. So taking a look at Tyson's valuation. So they reported an earnings per share of $5.42 over the last 12 months, and at a share price of $61, that puts the current price to earnings ratio at 11. I'd estimate going forward that they can achieve a 7% growth rate looking at the past 10 years, which gives me a fair PE value of 18.5. So that means based off of trailing earnings, I think that this is worth about $100.60 versus the current $61 share price. Analysts have 2021 earnings per share for Tyson's projected at $5.91. And at a price to earnings ratio of 18.5, that gives them a 1-year price target of $109.70 per share, which is 80% higher than the current share price. So I would say that this company has shown pretty consistent earnings growth over the past 10 years. It's in a healthy financial situation, and I do think that the share price is currently significantly undervalued. So that leads me to say that I think Tyson's is a very good stock buy right now in July of 2020. Okay, so the next company is CVS. So CVS's revenue from 2010 to 2019 grew from $96 billion to $256 billion. Their net income grew from $3 billion in 2010 all the way up to $6.6 billion in 2019. So looking at their balance sheet, they have $230 billion in assets to $165 billion in liabilities. That leaves them with $65 billion in equity. Their total debt is $92 billion, so that puts their debt at 104% of their equity. A little high, but still well within the acceptable range. CVS owns 9,900 retail locations and approximately 1,100 walk-in medical clinics. In the US, they're the top pharmacy by revenue for prescription drugs with nearly 25% of the market share. Recently, they acquired Aetna and are rolling out what they call health hubs. Health hubs are basically a portion of their retail store dedicated to helping people with chronic illnesses, where CVS can then provide the customers with medical products and services. Their goal is to create a more vertically integrated health service business where you can get treated at a Minute Clinic and then get your prescriptions filled at the CVS pharmacy.
Sleep apnea is one of the least or most undiagnosed opportunities, and so by having a respiratory therapist and the nurse practitioners collaborate, we can both screen and then provide and fit masks and machines and teach people how to use them. So kind of closing that loop around a condition that a lot of Americans have.
Acquiring Aetna gives CVS the ability to reduce costs of providing care because they're able to insure the people who are also buying the prescriptions from them. This gives them a big advantage over other pharmacies. So let's take a look at CVS's valuation. So CVS reported an earnings per share of $5.52 over the last 12 months, and at a share price of $63, that puts the current price to earnings ratio at 11. I'd estimate going forward that they can achieve about a 7% growth rate looking at the past 10 years performance, which gives me a fair PE value of 18.5. So that means based off of the trailing earnings, I think that this is worth about $102 versus the current share price of $63 per share. Analysts have 2021 earnings per share for CVS projected at $7.54. So at that PE of 18.5, that gives them an upside of 123%, all the way up to $139 from the current share price. So CVS, again, is another company that is seeing very consistent earnings growth over the past 10 years. They have a healthy balance sheet, and the acquisition of Aetna gives them a business that they can continue to grow going into the future. It also gives them a big advantage over other competitors because they can provide their services at a reduced cost, and the share price is significantly below what I think it's worth. So in July of 2020, I would also rate CVS a great buy. So my third company is AMD, and I'm going to talk about this section just a little bit different. AMD is in a much different position than CVS and Tyson's. The current CEO, Lisa Su, took over AMD in 2014. And at the time, AMD really wasn't doing very well compared to their main competitor, Intel. AMD was focused on the PC market, and in 2012, AMD only had 10% of their sales coming from non-PC products. They had a terrible debt situation where they had nearly no equity left and a few $1 billion in debt. Lisa Su refocused the company on what they're good at, which is high-end performance chips. Product development takes a few years for computer chips, so this wouldn't be a quick turnaround. She expanded the product lines outside of the PC market into the Xboxes and PlayStations. They also started to develop chips for data centers. Currently, AWS and Google's data servers use AMD. While I was doing research on AMD, I watched a bunch of interviews with Lisa Su, and in one video I happened to scroll down to the comments and I found one that I think really nails exactly why AMD has been so successful. They wrote that she is so successful because she loves what she does. I'm going to show a quick excerpt from the interview so that you can understand why that is.
It's really an honor to be here. And AMD is a company that's been around for 50 years. But we've never quite, hit our stride. And, 5 years ago, this was an opportunity for me. It was actually my dream job to run a semiconductor company. And many people would say, well, why would you want to do that?
It's what every little girl wants.
Yeah, that's right. Well, it's the idea that you can make something. You can build products, you can put it on a shelf, and somebody will buy it and will know that it's yours.
She really considers herself an engineer at heart and spends a lot of time working with the engineers, crafting their product and making it much better. Considering they're in the high-end computer processing market, I think that having a better quality product only helps AMD in the long run. And I think that Lisa Su's vision for the future is key to getting this done. So let's take a look at their revenue and earnings over the past 10 years. So we can see the revenue over the past 10 years really looks like a giant U. We can see right in the middle of it is about when Lisa Su took over, and you can see how she's made a big difference on how this company performs in the future and getting their market share back. You can see from 2017 on that their net income has really started to take off. Looking at their balance sheet, they reported $6 billion in assets to $3 billion in liabilities, which gives them $3 billion in equity. Their total debt is about $900 million. So that puts their debt at about 27% of their equity. So what are AMD's long-term prospects? Well, as the world moves more towards cloud computing and more powerful computers, AMD is really setting themselves up to benefit. AMD's resurgence also hasn't been good for Intel. They've taken away a lot of Intel's high-end market share and only have really left them with the low-end chip production, which has really disrupted Intel's finances. Intel is also having issues with their 7nm chips, and this really opens the door for AMD to be able to take a hold of this market share. So AMD over the past 12 months has reported earning 52 cents per share, and their current share price is $78. That puts the current price to earnings at $150. Now 150 times earnings is pretty high, but let's take a look at the 2021 analyst projections. AMD in 2021 is projected to earn $1.53 per share, which puts them at a forward price to earnings ratio of 45. I have them at a 20% growth rate, which I think is worth a PE of 59. So $1.53 times 59 equals a $90 forward valuation. Now, unfortunately, since I started doing the research for this business, their share price has gone up by a lot. So right now, I only see about 15% upside until 2021, which I think is still a pretty good number. I also think that if you were to buy the shares right now and continue to hold them for at least the next 5 years, you're gonna make a whole lot of money off of these guys. I think that their revamped business model is really setting them in a position to do very well going into the future. So even at only 15% below the forward valuation, I still think that this is a great company, and if you were to see any dip in the share price, I would definitely recommend getting aggressive and swooping up as many shares as you can. Alright, and the last company I'm going to take a look at is JP Morgan Chase. So we can see from 2010 to 2019 that the revenue went from $102 billion to $115 billion. We can see that more importantly over this time period, their net income grew from $17 billion to $36 billion. This puts them at a net income growth of about 12% over the time period. Taking a look at their balance sheet, they reported $3.2 trillion in assets to $2.9 trillion in liabilities. This gives them a total equity of $2.64 billion. Their total debt is $365 billion, which puts their debt at 138% of their equity. So the income statement and the balance sheet does look pretty good, but let's take a look at their long-term prospects. Banking is not going to go away anytime soon. So an important metric to look at for bank performance is return on equity. And currently JP Morgan leads the banking sector in the US with 15% return on equity. Their return on assets is 1.33%. And assets are basically the way that banks make money. They take those assets, they lend them out to other people, and people pay them back for borrowing those assets. So the more assets a bank has, the more money that they're able to make. Right now, JP Morgan is ranked 5th in the world for assets under general accounting practices. So on top of having a whole lot of assets, they're getting very high returns on those assets, especially compared to other banks. Now currently their earnings are down for 2020, but that's because they had to take an extra $15 billion and put it into their credit loss provisions, so that if people default on their loans that they're able to cover their losses. So right now they have almost $22 billion in credit loss provisions. So let's take a look at JP Morgan's valuation. So we'll look at JP Morgan in two different ways to value it. We'll use the price to earnings and we'll use the price to book. For price to earnings, they earned $7.42 over the last year, and at the current share price of $97, that puts their PE at 13. Banks always trade at very low price to earnings ratios, somewhere between 8 to 15. JP Morgan typically trades at about 13 for their price to earnings ratio, so that puts their current share price at around fair value based off of the trailing earnings. In 2021, JP Morgan is projected to earn $8.76. That gives them a future price target of around $114 per share. Let's take a look at their price to book value. So if you don't know what book value is, it's basically the equity that they have divided by the amount of shares that they have. So basically equity per share. Price to book value is basically the price of the stock divided by the book value. This is useful for banks because banks are so reliant on equity to make money. So JP Morgan reported a book value of $76 per share, and at the current share price of $97 per share, that puts the price to book value at 1.25. That's a 3-year low for JP Morgan. One thing that I think is really interesting with JP Morgan is because they tend to trade at a very low earnings multiple, that the share price tends to match pretty closely with their earnings. So if you take a look at their share price movement versus their earnings per share growth, you can actually see that it pretty closely matches up. So considering they have consistently grown at about 12% over the past 10 years, I think that there's a lot of forward upside with this company. JP Morgan seems like the type of company that you could just add to your portfolio and forget about, letting it pay you a dividend every month and letting it grow its share price every year. So just to recap, all 4 of these companies Tyson's, CVS, AMD, and JP Morgan. I think that all of these companies are very pandemic resistant, meaning that I don't think that their business model is in serious jeopardy because of the pandemic. I think that all of these companies are trading below their intrinsic value and have a lot of stable future upside that they're going to be able to return to you. And because I don't feel like it makes any sense for me to throw out picks and not really have any attachment to them, I've actually bought shares of all of these companies so that I'm going to ride along with you. I think it would be a bit disingenuous for me to recommend companies for people to buy and for me to not have any skin in the game. So I hope you liked the video. Comment below if there are any companies that you think I missed out on that I should have taken a look at. And if this video was useful for you, please take a second to hit the thumbs up button and subscribe. It really helps out the channel. Thanks for watching.